Inventories are assets held for sale in the ordinary course of business. If the entity is a manufacturer, its inventories would include the assets in the process of production for sale. It could also be the materials or supplies to be consumed in the production process or in the rendering of services. A wholesaler, distributor, and retailer which resells the same goods purchased from its suppliers to other customers have only one type of inventory. The first one, commonly called the finished goods. A manufacturer has all three types of inventory. The second one is also known as work in progress, and the third one, raw materials. FRS 2, paragraph 9 requires the entity to measure its inventories at either cost or net realizable value, whichever is lower. I will go through how cost and net realizable value is determined. The cost of inventories shall comprise all costs of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. The cost of purchase comprise of the purchase price, import duties, other non-refundable taxes, transport, handling, and other costs directly attributable to the acquisition of finished goods. Trade discounts, rebates, and other similar items are deducted in determining the cost of purchase. The cost of converting inventories include costs such as direct labor and a systematic allocation of production overhead that are incurred in converting materials into finished goods. Please note that the cost of conversion applies only to manufacturing companies. A retailer, distributor, and wholesaler will not incur conversion costs because it will resell the goods purchased without making substantial changes to the good itself. Next, the net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. Now that we have gone through the definitions of cost and net realizable value, let's understand what this means. Under normal circumstances, the net realizable value is higher than the cost, so we will value the inventory at cost. It is logical for an entity to sell its inventories above cost to earn a profit. However, what if the inventory could only be sold below cost? For example, the inventory could be damaged or it could be outdated such that it must be sold at a discounted price. If that's the case, the inventory will be valued at the net realizable value. To write down the inventory cost to the net realizable value when its net realizable value falls below cost, we debit impairment loss on inventory and credit inventory. Impairment loss on inventory is an expense. It would be aggregated together with cost of sales in the income statement. Strictly speaking, impairment loss on inventory is an inventory-related cost. That's why it is classified as cost of goods sold. This is just for your info. Inventories can be recorded in either the perpetual inventory system or the periodic inventory system. The perpetual inventory system actively tracks its inventory movement. When a purchase or sales occur, the inventory's figure will be updated. The periodic inventory system does not actively track the inventory movement. I will explain what this means later. Businesses will perform stocktake occasionally, but why? If the business uses the perpetual inventory system, a stocktake helps the business check whether the inventory balance per accounting records is equal to the actual inventory levels assessed during the stocktake. This can help the business identify if an error was made in recording or if there is any stock loss that occurred without the business knowing it. A periodic inventory system performs a stocktake to find the ending inventory balance. I suppose you notice that a stocktake must be performed for a periodic inventory system. Otherwise, the business will never know its ending inventory level, since it does not actively track the inventory level. A stocktake would be optional for the perpetual inventory system, and it serves more as a form of internal control. Now, this is the big difference between the two systems, the journal entries. To record purchase, the perpetual inventory system debits inventory, while the periodic inventory system debits purchase. To record sales, both systems will debit accounts receivable or cash and credit sales, but the perpetual inventory system will also recognize the cost of goods sold. The perpetual inventory system does not involve any period end closing entries, since the inventories are actively tracked. The periodic system, however, will debit inventory and credit purchase to zero off the purchase account. Next, it will debit cost of sales and credit inventory to reduce the inventory level to the ending balance determined in the stock take. By now, I suppose you realize that I have been using the perpetual inventory system all this while in my videos. The perpetual system is more commonly used now due to better technology to help track and record inventory movement on the go. However, I personally prefer the periodic inventory system because it is simpler and more cost-effective to use it. Both inventory systems have its pros and cons, so the entity ought to weigh the costs and benefits of each inventory system before deciding which inventory system it wants to adopt.